All right, let's talk bonds. Let's talk inflation. Inflation might be easing back a little bit. Is that going to help the Fed? Is that going to give them a little room to maneuver? Matt Phillips is here to discuss this one. Mr. Phillips.
Paul, how are you?
Good morning to you. How are you?
Doing well.
Back from your big trip across America. We missed you a couple of weeks there.
You should see America. It's beautiful.
Listen, I've done the cross-country thing, my friend. I've been there before.
You've been on the road?
You were probably in school, in high school, when I was out there doing my Kerouac thing.
Yeah.
No, but seriously. All right, let's talk about the Fed. Let's talk about inflation. Is inflation coming down enough that it's actually going to give the Fed some maneuvering room here? Big story. Look at this beautiful story, the graphics and the picture. Matt Phillips.
It's a thing of beauty. Well,
tell me what's going to happen.
It's not so much inflation, right, which is kind of a backward-looking measure. You can look at CPI. CPI is actually up. We had our most recent reading in April. It was up about 2.3%.
Sounds hot.
It sounds a little hot, but it's been that's the lowest year-to-year increase for quite a while. So people aren't really worried that much about inflation, and how that's transferring in the financial markets is through some things that look at inflation expectations. So going forward. One of the things you can do is you can look at the difference in the yield between the plain vanilla Treasury note and something called the TIP, which is the Treasury Inflation Protected Security. So basically that differential gives you a reading on about what people see inflation doing over the next,
and is that narrowing?
It has been narrowing for a while. So it was about 2.4% back in March. Now it's come down to about 2.13 or something. So what that's saying is that going forward, people see the average inflation rate over the next 10 years roughly coming in about 2.1%. That is not going to be, basically that opens the door a little bit more to the Fed if they want to do something. Because the big concern when the Fed has done stuff in the past like quantitative easing is we've seen inflation metrics go a lot higher. We saw, remember, gold prices going crazy.
Now, I got to tell you, that doesn't sound so good to me, because we know the Fed doesn't have an official inflation band, but we know they have an informal band, right? What is it, between 1.5 and 2%? They like to see inflation in that band.
Yeah, roughly 2%.
So what you're telling me is that it's at the high end of that, if not a little bit over it. How does that actually give the Fed more room to maneuver? It's
going in the right direction, is the thing. So it is coming down, and it's not saying that the door is wide open, but it's definitely moving towards the direction. The Fed has shown when we hit this like 2% area, that seems to be when the Fed's more comfortable about doing stuff. So we saw that.
And when we talk about what they're going to do, because we're running out of time here, I'm very sorry, you can read the whole story. What are we talking about them doing?
Well, I mean, the question is that are they going to do another QE program where they create money and buy bonds? Are they going to extend their Operation Twist program, which actually wouldn't create money and therefore wouldn't be seen as inflationary at all? So, you know, if they've signaled that they're interested in doing something if Europe gets a lot worse and the economy starts to stall.